I would first like to thank everyone from the Taxman team to organize these sessions. I have been part of Taxman for a very long period of time as a spectator, as a participant, as a service user, and it has been always phenomenally great. Thank you to the team first. Secondly, I would like to thank. I've got to know that this time Taxman got like 500 plus registrations for this event, so I believe valuation is the hot topic at this moment of time. So that's wonderful. I would like to thank all the people who are watching me live on Twitter, YouTube, Facebook, LinkedIn, Instagram, and specifically who are sitting here on the Zoom call. So thank you very much to everybody. I would also like to specially mention one of my partner, Mr. Kunal Narwadkar, was also part of this session today. So thank you, Kunal, for being part of this. How we will be talking about discounted cash flow and valuation and all of those. I would first like to talk about what valuation is. So, Kriti has told wonderfully about being that I'm partner, national leader, transaction advisory at Kirtane and Pandit, and I take care of valuation, due diligence, and M&A tax. That's my coordinates. If anyone wants to connect with me after the session, you're most welcome to connect with me post session. Uh, I would want to create this conversation a very interactive session. I generally communicate with most of the people. I've done this session at various platforms already, and I know how do you be interactive in the same session. Secondly, I'll keep the chat box open and I'll keep answering your questions to the max possible during the event as well. I did a very recent session with Taxman on M&A tax also. So in case anyone wants to look forward to that presentation, it is available on the Taxman's and even on my LinkedIn profile. So let's talk about why valuation is needed. Yeah, a lot of people tell me, what a valuation is a line wherein very few people are actually working in. And you know why? The reason behind it is the real knowledge and the real education for the valuation is ideally not available in most of the qualifications which are there in the regulatories. So, like for example, in the Indian Income Tax Act, it generally says that the valuation should be done by merchant bank. Yeah. Secondly, in the FEMA, it generally says a chartered accountant or a merchant banker. And in case of registered valuers under Companies Act, it says that a registered valuer under Insolvency Bankruptcy Board of India. So it's wonderful that government has come up with a great course on registered valuation, which I have cleared under Insolvency Bankruptcy Code, which has wonderful syllabus on valuation. So I cleared that, then I became registered valuer. But on the other side, if you see, when I did my chartered accountancy, the knowledge of valuation was very limited to very few subjects on the SFM, that is strategic financial management subject. And the secondly, on the merchant banker side, I've seen a lot of merchant bankers who are, company secretaries or chartered accountants or lawyers or things like that, but they're not, there in the line of the valuation itself. So that's a problem why very less people are there in the valuation. Now, my session, I can't guarantee that post this, you will ideally be doing valuation on your own if you don't know anything about it. Yeah. But you will definitely know how to talk about valuation if, as of now, you don't know how to talk about it. That's one takeaway from this. The second takeaway is, if you know how to do valuation, you will know what wrong you were doing. So I would love to see I confess in the chat box wherein you think that you have done wrong, you have been doing wrong, and I have told you something new. So these are few areas where the valuation is generally needed. Valuation is needed by a merchant banker, sometimes by a registered valuer under Income Tax Act when you do issue of shares, when you ideally do capital gains under 50 CA. For Income Tax Act, you need under Section 9, under Companies Act, under RBI FDI regulations, under RBI ODI regulations, under M&A, under purchase price allocation, as per SEBI, for SEBI under alternate investment fund regulation, valuation of sweat equity share, insolvency and bankruptcy code, and a lot of Indias actually specifically mention about valuations to be done at various statutes. So we'll talk about all of these purposes. You see, fundraise is one of the main purpose wherein valuation comes on regular basis. This is a regulatory valuation for which it comes. Second is FEMA. The third is income tax. Then intangible, PPA, and other accounting based valuation. So my first question to the team to make it more interactive, tell me one thing. Let's say a company's net worth is 10 CR and someone is purchasing that company at 100 CR. What is 90 CR? Can someone please tell me in the chat box? If the company's net worth is 10 CR and someone is purchasing at 100 CR, what is 90 CR? Yeah, started seeing answers. Goodwill, Silas saying goodwill, Vedant is saying goodwill, Vani is saying goodwill. It is good of you that you're saying goodwill, but actually it is not goodwill. So what happens is, in these cases, there is a purchase price allocation, which is needed while you do a valuation, which is known as post-deal PPA or pre-deal PPA. So for example, a company has customer relationship, company has brands, company has, assembled workforce, company has, non-compete agreement. All of these needs to be valued. And let's say you do a purchase price allocation ke andar, let's you do a brand valuation. You do it through royalty relief method. Yeah. The second is customer relationship. You do it through multi-period excess earning method. Let's say you are doing non-compete with or without method. There are great methods which need to be, which can be used while doing a PPA allocation. So this is one of a area which is much talked about. A lot of assignments come in this line. So that's where valuation comes in. The premium of share or goodwill, fair value, people are saying, yeah, wonderfully great. You're right on what you're saying, but purchase price allocation is actually the right answer. You need to do identification. Remember in the those who are chartered accountants or company secretaries or those who have learned accounting standards over a period of time, they would remember that if the asset is identifiable, quantifiable, and has a way of generating revenue, then it is considered as intangible assets. So we have to, when you are acquiring a company, that 90 crores needs to be divided into various intangible assets. And then whatever is left, we put it into goodwill. Then come Companies Act, portfolio valuation. There are a lot of AIFs which need portfolio valuation on regular basis. I do it for a lot of companies wherein they have big portfolios. They have companies across world wherein we need to do valuation. Then comes model development and analysis, wherein you're developing a model only. That is, sometime a new startup has come up, or a new company has come up, or a new unit of a company has come up, or sometimes for the project analysis, you would have to do projection of the company. So that is where the projection of the company sits. There has been a recent amendment in 11 UA. That's not part of my presentation today. So I will just touch upon it. Why are we talking about discounted cash flow method? Is because most of the valuations, in every valuation, whenever we go for a valuation, discounted cash flow is one of the accepted method of doing the valuation. Though there are other methods also to do the valuation, but discounted cash flow method is nowhere written cannot be done. There are a lot of methods other than discounted cash flow method, like comparable company method, comparable transaction multiple method, market approach method, net asset value method, but those methods cannot be used as most of the areas. So hence we are talking about DCF as an area. There has been a recent amendment under Rule 11 here, which talks about domestic as well as international methods for non-residents and domestic methods for residents, wherein until now the valuation was not needed when the money was coming from abroad. Now the valuation is even needed when the money is coming from abroad. So which means the horizon of valuation has increased tremendously over a period of time. So there are still few countries like US, Europe, who are exempted from getting the valuation, but approximately 50% of the FDI which comes into India comes from Singapore and Mauritius, and they are not exempted. So still valuation need to be done. I have a problem in 11 UA specifically, which is relating to few things which are there. The first thing is, let's say in one round, there are residents and non-residents who are investing together. Now, can I do valuation by two methods? For a resident, I'll do by DCF, and for non-resident, I'll do it by these methods. Now, if I do valuation by two different methods, it will never ever give same valuation. It may give valuation in different range, maybe a near range, but it will never give same valuation. Now, the problem is, can I raise funds at two different valuation? Because Income Tax Act says that for non-resident, you may choose discounted cash flow or may choose these more methods, or you may choose only discounted cash flow. So the problem is, if the round has both residents and non-resident, you cannot use these methods. You have to use only DCF method. That's what it says. Now, the next is valuation is valid only for 90 days from the date of valuation report. Now, can someone tell me these 90 days? So let's assume I did a valuation on numbers based on 31 Jan 2024. But I signed the valuation on 20th February 2024. Will these 90 days be calculated from 31 Jan or 20th February? A question to all of you, these 90 days from the date of valuation, should it be 31 Jan? Nilesh is saying 31 Jan. Others, please, 31 Jan or 25? I'm signing the report on 25, doing valuation on 31 Jan. Can anyone please tell me whether it will be 31 Jan? It should be 31 Jan, but it is 20 February. Sahil is saying. Muthu is saying 31 Jan. Rashmika is saying February. So let me clear this thought process for you. Because it is not clear in the law specifically, it says date of valuation report. We should ideally consider 31 Jan. Now that is a loophole in the law. You may consider valuation report. You may consider date of valuation. Date of valuation report, it says, so you can consider date of valuation. You can consider date of valuation report. If you do date of valuation, you will at least be more compliant. Second, it says is that you can do valuation for resident and non-resident at two different methods. That I've already told in a place that, let's say you are doing a valuation under the residents and the non-residents, you should only use discounted cash flow. You should not do two different valuation methods. So can there be two different valuation in same report? It cannot be. Yeah. So going forward, there is some point wherein we talk about startups not having valuation report. Can someone please tell me in the chat box, do startups who are registered under DPIIT need valuation report under Income Tax Act to raise funds, or are they exempt from income tax? Can anyone please tell me? Do startups who are registered under DPIIT need valuation report, or are they exempted under Income Tax Act? Exempt. Aditya is saying exempt. Can anyone else please also help? Need valuation report, Nilesh says. Next. So let me tell you, let me clear the query for you. The point here is there is a problem in that. You are exempted to take valuation report. You need to file a form 3 there on the DPIIT platform. But if you do not take valuation report and you file a form 3, you are restricted for a period of 7 years to do capital contribution to any other entity or shares and security, which means that if you don't take valuation under Income Tax Act by a merchant banker and you do form 3, you are not allowed to start a subsidiary for next 7 years. Now you see how big this can be a problem for the startups. You are advising, you are saying that you don't take valuation from a merchant banker. And what do you do in that case? You do just, you sit down and you can't do any investment into any startup. Let's say you want to do investment and do a subsidiary. You don't want to create a subsidiary, just want to invest. You can't invest from your company, number one. Number two, you cannot do a capital contribution into any other entities. You cannot create a subsidiary. So this is a big problem which is there. So only the red ones are relevant. Others, they are actually saying for the purpose of business, you can do whatever you want to do. Other than that, you cannot do that. So that's where you're talking about. There's another very interesting thing is that in case you are, so a lot of startups, a lot of people, what they do is once they get the funding for the regular movement of the founders or for the company, they buy a few cars. Yeah. You can't buy a car also. So a motor vehicle, aircraft, yacht, or any other mode of transport, actual cost of which exceeds 10 lakh rupees. You're a founder, you're raising crores of rupees. You'll not buy a car for 10 lakhs. Other than that, held by startup for the purpose of applying, hiring, leasing, or stock in trade in the ordinary course of business, which is not the business of most of the startups. So this is a problem. So problem one, you can't open a subsidiary. Problem two, you can't invest. Problem three, you can't buy a car. So car is a very small problem, but other two are very big problems to be considered. So that's where the problem comes in. For another 7 years, you can't do that. So that's a problem. Now, how do we do valuation? Let's say you're sitting in front of a CFO and he just turns up and says, Gaurav, I want a valuation to be done, and you have no clue how valuation is being done. Just talk to him that I'll first analyze the historical data of the company. Then I'll broadly analyze the financial forecast of the company, which projections you will be giving. There is, if they have CBDT approval via startup recognition, 31 Jan. People are answering on question and answer, please reply on chat. Yeah. So broadly analyze the financial forecast, hold discussion with management. Then we will ideally be conducting industry research. Then we'll conduct valuation using appropriate approaches and prepare valuation report, discuss result with the management. So what do we do? Number one, we check the historical financials of the company. Number two, we check the projections which are given by the company. Number three, we'll hold discussions with the management in relation to whatever information they've sent across. We'll conduct an industry research. We'll conduct valuation using appropriate approaches and prepare valuation report and discuss the results with the management. That's how we'll be ideally be doing the valuation. There are various approaches. Again, why are we talking about DCFS? PwC did a research recently and they said 58% of all the valuations that are happening, the method used is discounted cash flow method. So which means more than 50%. There are, at this moment of time, we've just written 4 methods. There are n number of methods to do valuation, but we've just written 4 methods here other than discounted cash flow. And 58% of the valuations are happening from discounted cash flow. 42% of the respondent using at their preferred approach. With market approach is also an important. But it has been said in the market approach, they're also using net asset value method because that is required under the Income Tax Act and various acts. So PwC did this research globally, and wherein 58% discounted cash flow method was talked about. So what are the documents needed? We need audited financials. We need provisional financials as on the date of valuation. So a lot of people call me and say, Gaurav, I want to get a valuation done. Can you please help me with the information requirement? Please note it down and send me these information. I'll do the valuation for you. So how does it work is I need an audited financial, I need provisional financial, I need projected financials, I need anticipated working capital and capital expenditure, and also I need fully diluted shareholding pattern. If you give this, the valuation can be done swiftly. So that's how the work is done. Now, let's talk about the elephant in the room, that is discounted cash flow method. So the first and foremost is we talk about 4 pillars of the valuation of discounted cash flow method. The first pillar is the projections. The second pillar is the discount rate. The third pillar is the terminal value. And the fourth pillar is after adjustment. So we'll talk about all the pillars very briefly because we're already at 5:20. We have session till 6 o'clock. We'll spend around 10 minutes each on the first 3, 5 minutes on the last. And we will conclude the whole within 5:55 so that we have time for more questions to be asked by the participants. Now, but don't worry, it's a sufficient time to do it. And I'll also run a live model with all of you while I talk about discounted. So a lot of people says, can anyone please tell me, says se pehle question puch lete hain, whether projections are the responsibility of the management or the responsibility of the valuer? Can you please answer? Are the projections responsibility of the management or responsibility of the valuer? So Aditya is saying management, Rajiv is saying, Nilesh, Lance, George is saying management. Wonderful. A lot of people are saying, all of you are saying management. Management. Do you know, under Insolvency Bankruptcy Board of India, registered valuer, guidelines and code of ethics, it is written that the valuer should take reasonable assurance over the projections given by the company. Jahan assurance word use hota hai, wahan pe what do we become? We become a bloodhound, not a watchdog. So what do they say? A regulator or a professional is a watchdog, not a bloodhound. And that's what it says. But when you talk about assurance, you're actually a bloodhound, not a watchdog. But again, it's not that risky, or if the company has given the projections, we don't have to worry about it much. But there is still an assurance which we need to take from the projection. And I'll tell you why projections assurance needs to be taken. So there is a common sizing which needs to be done. How do you take it? Is that, let's say a company had an EBITDA margin of 5% in the current financial year, and they are saying next year they will ideally do 10%, then 15, then 25, then 35, then 45%. That's the EBITDA margin they are saying every year, percentage of revenue that they will grow. Now, this is not practical at all. This is not practical at all. What is practical is you look at the industry's number. So there was a company which came to me for the purpose of they were a car manufacturing company. So I was doing a valuation because they were raising a round very soon. While I was doing the projections, I checked that they are majorly into hatchback cars. and they are entering India and investing, getting investment done in the Indian entity. So I looked at other industry in the car wherein the EBITDA margins were around 18%, 17%, 15%. This company on the other side was talking about 35%, 40% of EBITDA margins. Now, while you are doing a valuation, you have to go back to the client and tell them, hey boss, knock knock, you cannot have EBITDA margins of 35%. You have not had it in the world until now, internationally also, wherever geography you are sitting, you have not had these kind of EBITDA margins until now. How are you thinking to get on EBITDA margins of this sort? Now, I'll give you another wonderful example of the industry trends being used. There was one company who came to me. They were into jet manufacturing, so private jets, where we all generally travel. I don't, but you people. So the point was there when they came to me and said we want a valuation done. We're getting a 5,000 crore kind of a number, and we are raising 500 crores. Can you please validate our valuation? So I said, okay, please send me the projections and all of those. So they sent me a projection and they said currently last year they sold 7 jets. That's it, 7 jets. Okay, only 7 jets they sold last year. Next year they are expecting to sell 15 jets. Next year they are expecting to sell 30 jets, then 70 jets, and then 100 jets. That's what they said. 7, 15, 30, 70, 100. I was happy. Okay, it is possible. Maybe they're talking about it, maybe possible. They were doing 6-seater jet only. I looked at the industry per se. The industry numbers were very easily available. I looked at the industry numbers and I got to know that last year only 45 people bought jets. 6-seater jets were only bought 45. That was the total number of jets being sold last year. Now, while I called the CFO back and I called him and I told him, boss, I've got projections from your company, from the business team, and they are saying that, and even the CAGR of the same is going at 15% approximately as of now, because people have started buying personal jets a lot. So now with that, they are ideally saying ideally 10% or 15. So they are ideally saying that they will do 15 next year. Total was 45. Let's say 50 is next year. Of the total gamut, you are saying you'll have 1/3. Okay, I can agree on that. Maybe you are able to do that. Next year, you are saying 30, which is approximately 50% of the total. Okay, I agree. Let's do it. Next year, they are saying approximately we will be at 70 number. Why are you going to sell 70 numbers? There are no buyers for it. The total market is of 66 people. That's it. And you're talking about selling 70. Who are you going to sell? Even you're going above the market. That's not possible. So the CFO was like, yeah, I know that. We did not do internal analysis. We were just looking at the numbers to come in and we were just talking about it. And you can't really sign on these numbers being a valuer. So I called them back. I said, let's sit down. Let's create the projections in the right manner. We did a strategizing thing. You should not only be doing 6-seater jet. You should do 12-seater jet, 10-seater jet, 25-seater jet, so that the revenue number goes up over a period of time, and then the valuation can ideally be talked about. So this is the kind of a number game which we did. But this was again a jet company, very big company. There was a company which was into steel tubes manufacturing. Yeah. Now this steel tubes manufacturing company told me that we are looking to raise at a valuation of 400 CR. We are raising 40 CR at this point. I was happy. Okay, no problem. I said, please send me the projections. So what they did was they sent me a projection wherein they were at 100 rupees of, let's say, revenue. They were talking about going 125, 150, 175, and 200. So from 100, they were going 200 in the numbers. Yeah, it's possible. There is no problem. 5 years, they're saying from 100, we'll go 200. That's possible. There's no problem. Now, I called them and I asked, CAGR, Silas saying CAGR might also increase by then. But sir, still whatever CAGR will be, they cannot have 75% of the total market, whatever CAGR will be. They cannot have 50% of the market. There is total addressable market. I've been called that CAGR might increase. I'll just go back to the aeroplane industry example. Total addressable market of this kind of jet is just 45, let's say today. Yeah. Let's say it goes to 70 by the next 3 years. So total addressable market is 70. Now, serviceable addressable market means that people who will buy from a smaller companies like us, those who are not going to Boeing and Airbus, I come to tier 2, are approximately just 40% or let's say 50% of the total. So let's say 35 people will ideally buy from me. but I am not the only player in the market. There are 3, 4 players also. So I cannot own 100% of the total market, which is there. So hence, my serviceable obtainable market can ideally be, let's say, 50% of the serviceable addressable market. I'll be at 17 or 18 as a number. That's where you think about it. That's where you talk about the number. So that's where we were talking about. But I will come back to my example of steel tubes. So they were saying 100 to 200, they'll go in 5 years. I was okay. I called the CFO, even the CEO on the call, and I asked them, sir, what is your current capacity utilization? And they were posting about it. Gaurav, we have 85% capacity utilization. I was happy. Wonderful. We're 85%. I said 85% means that you are doing your best at this moment of time. They said, yes. So you're going 125 next year. You must be doing some trading in the revenue. So they said, no, 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 Gaurav. Management has strictly said no for trading because we cannot compromise on the quality, and even the prices go up and down every year, every time. So we can't really work on the trading. Okay. I said, maybe you're going for job work in that case because your revenue is increasing. So he said, no, investors have said no for job work also. They said the quality of the product goes down if we do job work, so we'll not do job work. I said, okay, then there may be expansion in the factory for sure. There should be capital expenditure in below. So I went down, I looked at the projections. The capex was just 1 to 2% of the total revenue, which could never put in a factory. So I told them there is no factory coming in, there is no job work, there is no increase via trading. How are you going to achieve these numbers? And again, the CFO and the CEO had an answer. The business team created it, the tax team created it. We had no answers for it. And everything shattered. So I had to sit down with them, do the whole thing again, talk to them and understand the whole thing. Is that if the investor is willing to invest at an X price, no matter how arbitrary the price seems, what should the valuer do then? That's what I'm saying. So I've been asked a question by Sahil. He says that if the valuer, if the investor is ready to invest at some price, and we are talking about it, I am here talking about not saying no to a valuation which has already been set, or maybe it is already being talked about. I am talking about how to create a right story behind it. You are signing it, under the act, under the regulation. You are supposed to sign it. Now, this is one. I do 40% of the valuations for internal management analysis, wherein the company comes to me and says, you please tell me what should my valuation be. Now, 40% of the valuations are that, 60% are regulatory valuations. Now, under the regulatory valuation, I talk to them about the projection so that I add some value. If you will keep doing those things which others are doing, you are adding no value to the company. You will end up doing an income tax return like a valuation report. So that is not allowed. Now, I was doing another projection creation for a company which was into garage, like Go Mechanic. Yeah. So good 2 examples. We've taken aeroplane industry, we've taken tubes and all of that. I sat with them, created the projection. In the case of, I was talking about total addressable market. So Go Mechanic kind of a company. Let's say in your area, there are 10 garages. Yeah. So the total addressable market is 10 garages for the Go Mechanic kind of a startup. Now, out of those 10 garages, only 5 will ideally say that we will adopt someone else's brand and we don't want to work under our own brand. We are ready to have someone else's brand written on our shop. So only 5 will agree to it. Now, I am not the only player in the market. Yeah, there are other players also in the market who are similar to Go Mechanic. Now, when I'm doing it, out of 5, there will be 2 or 3 who will ideally agree to take my brand instead of anyone else. So what it says is, out of the total addressable market, total addressable market, serviceable addressable market is 50%. Serviceable obtainable market is just 20% for that. And we also need to see what is the customer acquisition cost. Now, customer acquisition cost actually depends upon the time value, lifetime value of the customer. So let's say one garage who comes to me gives me around 2 lakh rupees per annum. Yeah. So my customer acquisition cost can ideally be anywhere 1/3 of the lifetime value. These are few terms which have been done over a period of time. It says it can be around 1/3 of the total value, which means if it is 2 lakh, I can spend around 50,000 for acquiring one customer. Now, because I have to go to the whole market, total addressable market, then serviceable addressable market, then obtainable market, which means I will be spending 50,000 to get one customer and I'll be spending on 5 people for that. So 10,000 you spend on each customer, then you come down to two, then you come down to one. You will have one customer wherein you're spending 50,000 to get one customer. Yeah, that's where it is. Now, that's how the whole projection thing works out. Now, I'll also talk about the few very important things, like, for example, initiating coverage. Yeah. Uh, when we invest into start, there was one startup which came to me. I'll not name them as we are live currently. So that startup is a unicorn in India. Yeah. But has zero revenue. Had zero revenue when they were unicorn in the country. And I was amazed. They called me and said, Gaurav, can you do a valuation? Okay, yeah. And said, what is the valuation you got last? They said, we got a $750 million. We are eyeing a valuation of around $1 billion. Can you just see and validate whether our valuation stands there? I was okay. I said, send me historical financials. They said, I saw the revenue at zero. Was okay, it's zero. Then the second came and they said, Gaurav, approximately our the next year projection is also zero. I said, okay. And then the next year projection was very small. They'll start monetizing that year. I was amazed to see a company had already raised funds at $750 million valuation. And they are currently talking about 1,000 million plus valuation and the revenue is zero. Now, how do I do a valuation like that? How do I talk about the projections of this company when there is no trend per se? So the trend is not about the company. The trend is about the industry. What I did was I went to initiating coverage report of the comparable companies of this. Now, what is initiating coverage report is when mutual fund investors or various analysts are putting their money into some stock at that time, they initiate a coverage report wherein they do a 20-30 page coverage and they say that this company will grow with this CAGR, the industry will grow with this CAGR, the company will grow in these areas over a period of time. Next 5-year projection is this, next 5-year target is this, and they talk about the whole business as such. So I got one company which was directly comparable to them. I could see number of clicks on that company. I could see number of paid customers. I could see number of unpaid customer. I could see free customers and all of those. And I could compare that to my company as well. So if they were working with, let's say, 1 lakh customers at this moment of time, my company already had 10 lakh free customers at this moment of time. Out of 1 lakh customers, they had 30,000 paid customers. My company was only saying that they will have out of 10 lakh customers, they will have just 50,000 customers paid. Now, my company could have been valued much more than their company. When I looked at various other numbers, my company's subscription price was low. My company's cost of ad was low. My company's marketing was low. My company's spend on the IT was very low, and then they could have good EBITDA margins over a period of time. So I could substantiate those projections looking at the industry. And, be with me, I'll tell you, while I was doing valuation, I could have given a valuation of $2 billion to this company because the kind of business they had created was wonderfully great. If anyone can idly talk about this company's name, I would be very happy to listen. Agar kisi ko pata ho to. But I'll not name it. So then rather we should keep the sales at a lower level and then increase the margin, justify the already set valuation. So we'll talk about this later in the presentation, or you can connect with me personally. Yes, you are right on the same. Now, a lot of time there's another problem which happens is sometimes the company has gone into, can someone please tell me full form of SHA and SSA? Do you know SHA and SSA are two agreements which are done while a company is raising funds? What is the full form of SHA and SSA? Can someone please tell me what is the full form of SHA? Yeah, shareholder agreement. Wonderful, wonderful. And what is SSA? Shared subscription agreement. Yeah. So a lot of time in the SHA and SSAs, company puts in the projections of the company which they're expecting over a period of time. Yeah. So when you do, so thanks Aditya, Rajiv, Nilesh, Sahil, Aditya again for helping this out on SHA and SSA. When you participate, it actually looks really nice. Otherwise, it looks like I'm talking to my laptop. So thanks a lot. So while I talk about SHA and SSAs, there are a lot of investors and a lot of companies have given their projections. Now, the projections which are there in the SHA and SSA versus the projections which are given to you, may be different. Ideally, they are different. You should not sign on a projection which is given on the SHA and you are talking about some other number. It should not be like that. If they have agreed upon some numbers with the investors and you are being given some other projection to actually do regulatory work, you should say no to it. You should tell them that ideally amend the SHA or talk to me with the right projections in the name. So that's where you need to take care of your risk. So when you do projections, you need to take care of various things. You need to look at common sizing, industry trends, look at TAM, SAM, SOM of the company, look at whether the projections are given to investor or not. They should be initiating coverage report and analyst report of comparable companies to look at if the projections are right or not. Sometimes because the numerator of the companies are denominator of the company is generally small, so the increase is generally higher. So maybe initiating coverage report and analyst report may not work, but most of the time it does work. So budget or target, but not aspirational kind of a thing. So that's where the projection as the first pillar ends. Now, there are two kind of projections. One is FCFF, the second is FCFE. Can anyone tell me difference between FCFF and FCFE? What is free cash flow to firm? What is free cash flow to equity? What is the difference between both of them? Though it is written also, you can read it and say, but if you know it already, I would like to have some answers, quick answers. Yeah, Silas saying firm includes debt as well. Yes. So when we talk about free cash flow to firm, it means any movement in the cash, in the debt movement and the interest shall be covered in the FCFF, but in the equity, we also decrease the interest and the debt movement. If they're paying debt, we're getting new debt, that also included. Now tell me one industry which can only be valued on the basis of FCFE and not on the basis of FCF. One industry which can only be valued on the basis of FCFE but not on the basis of FCFF. Aditya, you're saying right. Rajiv, you're saying right. Anyone else, please? Yeah. So it is banking, non-banking financial corporations, those who have debt as the working capital. So these companies can only be valued by FCFE and cannot be valued by FCFF. When you do FCFF, the discount rate should be weighted average cost of capital. When you do FCFE, the discount rate should be cost of equity. So that's how the projections work out. Now coming to the second pillar. Wonderful pillar, discount rate. Now tell me, who has the responsibility for discount rate? Is it the management or the valuer? Who has the responsibility for the discount rate? Valuer, valuer. Wow, Aditya is saying valuer, Rajiv is saying valuer, Lance George is saying valuer, Selva Muthu is saying valuer. Wonderful. So it is the valuer's responsibility. This is the most important area of doing the valuation, discount rate. Yeah. While we do discount rate, I'll talk about a model. So I'll bring it a little closer to me. Yeah. So I'll run a small model with all of you. Now, this model is ideally, can someone please tell me, I did a valuation for one company which is doing something like fantasy sports. Can someone please tell me a few startups in the fantasy sports area? Fantasy sports, yeah. Dream 11, Dream 11. Everyone is saying Dream 11. Yes. So I did not do valuation for Dream 11. I was doing it for someone else. And someone also tell me, well, I was looking for comparable companies. There was one company in India who runs casino in Goa. Can you tell me what is the name of the company who runs casino in Goa and is a listed company? Delta Corp. Wonderful. So Deltin Royale, Delta Corp, that's where the company is. So I looked at, approximately 1,084 companies who are actually doing the business like fantasy sports. And when I looked at India as such, there were very few companies which the companies which were having business in India and they were doing fantasy sports. So I looked at headquarter country. I looked at only these four companies were there in India. Now these companies were taken out because their net income was less than zero. They were loss making at this point of time. So I couldn't do anything about it. They were currently loss making. So I had to choose other companies, look at the world as a sphere, and I looked at these companies. These were seven companies which were ideally getting the similar kind of a work. Now, a lot of people tell me that in a lot of valuation reports, I've seen people saying, as there is no comparable company, hence considered beta of 1. Now, can someone tell me what is beta, please? Beta, what is beta? Why do we do comparable company analysis? Why do we do comparable company analysis? Can anyone please tell me? Sahil, it was making losses in that year. So that was the problem. Other years, it did not make losses. So if you see Delta Corp, I can't find the net income number right now, but leave it. Yeah. So the question is value of one with respect to another beta is equal to beta. So what it says is, let's say you tell me one answer. If Sensex goes down by 1%, Reliance also goes down by 1%. What is the beta of Reliance? One. Great. So the startup should ideally have more as a number. They need to have bigger betas approximately. So we do comparable companies for this sort. Now a lot of people says, as there is no comparable company, we consider beta of one. There is no company which has no comparable. Like for example, Ola is coming out with Ola Electrics, listed entity. Yeah, and they say there is no comparable company. Now Ola is dependent upon two-wheeler segment as the comparable company. All two-wheeler segment companies are ideally his comparable company, because the industry where he sits is the two-wheeler sector. If people will buy two-wheelers, they will choose to take either gas-based or electricity-based. If they don't buy two-wheelers, they will not buy any of the two-wheeler. You leave behind you're an electric or you are whatever you are. So that's where we talk about. That's where we think about that. So there are a lot of companies which do not have direct comparable company, but they have comparable industry to which they belong. You need to do the industry analysis in those cases. If I did this, I came back to a number of this, then I went to WACC, weighted average cost of capital. There is a formula for cost of equity, which is the most common formula, which is known as CAPM formula. Can someone please tell me the full form of CAPM? Full form of CAPM, please. While we do cost of equity calculation, we do valuation via capital asset pricing model. Yeah, wonderful. So it's capital asset pricing model. The formula is RF plus RM minus RF into beta. How do we calculate risk-free rate? Risk-free rate is ideally 10-year government bond yield. I looked at 10-year government bond yield of RBI for 4 days, ideally 31st March, 30th March, 29th March, 28th March, and average came at 7.53%. I also did S&P BSE 500 index, which was 1st February 99, 31st March 23. So how do you do RM? Risk free rate तो पता लग गया. RM minus RF में RM कैसे आएगा? So for that, what I do is I take on the date on which BNC 500 index was actually listed. It was listed on 1st February 1999 with a base price of 1000. As on 31st March, it is at 21,324. With years 24, the CAGR has been 13.5%. So my RM is ideally 13.5%. I go down to RM minus RF of 6%. These were my comparable companies. I tried to unlever it, relever it. We don't have much time to talk about unlevering and relevering, but it's basically to remove the debt effect on that beta and to relever it by the industry debt equity maybe, or by the company's debt equity subjective to the valuer. Yeah, I did that. Then I added few of the discounts. So let's talk about few discounts which are very, very important. There's another very interesting thing which I wanted to talk about is, can anyone tell me the living god of valuation? Who is the living god of valuation? Yeah, Damodaran sir. Sahil is saying Damodaran sir. Yes. So I've seen, this is an abstract from a valuation report which I was reviewing. And they said source beta by Aswath Damodaran. When Aswath Damodaran take out his useful data set and he says that why you use my numbers, you can use my numbers for the purpose of benchmarking, but should not use my numbers for the purpose of doing the valuation. A lot of people, I've seen so many valuation reports which I review wherein it was written beta by Aswath Damodaran. It's not allowed. He's not your partner. Until Aswath Damodaran is not your partner, please don't use his name in the valuation reports. You can't just say beta by Gaurav Sukhija when Gaurav Sukhija is not your partner. Yeah, so you cannot say beta by Aswath Damodaran. Aswath Damodaran is no institution which takes out beta or something like that. You're not allowed to do that. So this company did a valuation, cost of equity was 30.9%. They were expecting whatever that was there. Now I'll come down to a small example. We have 12 to 13 minutes left. I'll come down to a small example of minority discount, control premium discount for lack of market, discount for size and margin. There's a startup, generally, how do I define a weighted average cost of capital discount rate? A generally large cap mutual fund will give you a return of 12%. Am I right? Yeah. A small cap mutual fund will give you a return of approximately 17% or 5 years CAGR I'm talking about. Yeah, generally it gives like that. That is your expectation. It doesn't give or give it. It's a different question, but that's your expectation that, let's say a small cap mutual fund will give you a return of 17%. A large cap mutual fund will give you a minimum return of 12%. That's your expectation from it. Now, how can you say a startup can be valued at a cost of equity lower than that? I have seen valuations coming to me at 11% of cost of equity. That's huge. You cannot consider 11% of cost of equity. Now, the second is that when you talk about discount for lack of marketability, now, so when a startup comes to us, the first thing which I say is, if I am investing for a minority share in the company, I needs to have a different discount, because when I invest into a company, I have no information of the company. The company, if I, let's say the company's valuation is 100 crore and I'm doing it 1 crore as a valuation, I'm just taking 1% of the company, and I go to him every week and I ask him for the information, he'll not give me. He'll just tell me, when I put the annual report, just pay 50 rupees from the MC and take the information from there. I'm not supposed to give you information on those things. So that's a problem I have. So let's say 17% is the cost of equity, which is there for a small cap mutual fund. I will add approximately 10 to 25% over it. So let's say I add 2% over it, we go to 19%. Second is discount for lack of marketability. Is that a small cap mutual fund can still be sold in the market? Yes, but a, uh, a share of a startup cannot be sold in the market like this. There is no gray market generally available for small startups to sell. You will be able to sell it when you go for an IPO, or you go for, when they go for a secondary sale or things like that. So the point is, when the things like this comes up, discount for lack of marketability can be added. Let's say another 2% is added to it. So 19%, 2% added for discount for lack of marketability. Now, the comparable companies which I have considered, which I say small cap mutual fund, startups are generally much, much smaller than those small cap funds, and they are currently not earning good margins also. So there should be additional 2 to 3% which we need to add for discount for size and margin. So this all can actually talk about increasing the whole cost of equity from, let's say, 17% to approximately 20 to 23%. If any startup you're valuing, you should not keep the discount less than 25%. Wonderfully said, Nitesh. When you're doing a startup valuation, you should not do less than 25%. I have seen valuations coming at 12%, 13%, 15%, 18% is a common thing. People are putting valuations at 18%, saying it is giving more than small cap. I've considered 1% over it. So ranges between 10 to 33% means no side. It does not range between 10%. It can ideally, so 10 to 33% control premium I'm talking about. Let's say you are getting a control in the company. This is a premium you will get. So if you're talking about 23% as 25% as the cost of equity generally for a company, when you have a control in the company, you have rights over it, you have a board seat, you can talk about it, do things. So you should expect less return from that company because you have less risk, because you can manage things there. So hence it should be a 2% kind of a discount there, wherein you will expect 23% out of it. So so it depends. So it actually depends upon the purpose of the valuation. So if the valuation is for a minority, you can increase the number. If it is for a majority stake in the company, you can decrease the number according to that. So that's where the discount rate should sit. So yeah, are we getting control or not? That's vice versa, I guess. So that's where discounts and premiums comes in. Then comes terminal value, because we're left with very less. So I'll not run it through the model, but I'll just show you the basics of Gordon growth in this. The most used method is generally the Gordon growth method. The second use is H model, and the third use is exit multiple. Gordon growth method is generally used when the company has stabilized earnings in the last financial year where you are investing. Now, in my case, the company was still increasing by approximately 30%. Yeah, when it was increasing by 30%, I can't really say. So the TVG, which is terminal value growth rate. Now, just asking another question to everyone. Tell me, who is responsible for terminal year value? Is it valuer or the management? Who is responsible for terminal year value? And It is the valuer. Wonderful, wonderful. Can you tell me on an average, what is the percentage of value comes from terminal year? If let's say 100 rupees is the value which comes, Kaushik is saying 5% value comes from terminal year. No, no, that's the terminal year, terminal value growth rate. What is the percentage of value which comes from terminal year? Means अगर आपकी कंपनी 100 करोड़ की है, 5 साल की प्रोजेक्शन है, 5 साल से कितनी वैल्यूएशन आएगी? How much valuation you will get from the first 5 years if the company is 100 crore, and how much valuation will come from the terminal year that you're talking about? So Naman is saying 70%, Sahil is saying 80%, Aditya is saying 60%. Kaushik is saying 80-85%. Wonderfully great. It does goes like that. It goes more than 50%. So which means that while you're doing a signing evaluation report, approximately 70% of the value is coming from you. It is not coming from the management. So it is not dependent upon projection. So you are the one who has to take care of the thing. The one who has to own the valuation. So now for terminal year, you can choose to take Gordon growth method. But if the company is at a 10% growth rate, you can say a terminal value growth rate of 6% is still manageable. But let's say your company is at a growth rate of 30% in the last year, you need to go for a method like H model. What does H model do is it talks about that high growth period, post explicit period is 6 years. That is from 30%, when it goes to 6%, it will take 6 years going forward. There's a formula which you can Google and see. This is the formula H29 into 1 plus C5. What it does is, over a period of time, it brings that down gradually, and then it capitalizes it like the Gordon growth. Does the same what Gordon growth method does, but it also capitalizes it over a period of time. That's how it is done in the H model. The last but the least is not exit multiple method. Exit multiple method is used. Let's say your company's revenue has stabilized over a period of time. So let's say you were at losses. The company was at losses of 10% in the first year. They were at a losses of 5% in the next year, at 0% in the next year, at 2% in the next year, and at 3% in the next year. And they have a potential to go to 10% of EBITDA margin. From minus 10, they've come to 3%, but they have potential of going to 10% EBITDA margin. Now, at this moment of time, you cannot consider free cash flow to firm as a representable number. But on the revenue side, they are saying now we will not work on increasing the revenue. Now we will work on decreasing the losses in the company. So if you are talking about stabilizing the revenue and not talking about stabilizing the EBITDA at this point of time, you should use exit multiple method on the EV revenue multiple. Generally, there are other reasons to use EV EBITDA multiple for exit multiple, but you should ideally be using these methods. Then you can subjectively choose to use any method at any moment of time. Generally, it should be used in these methods. Then comes after adjustment, the last pillar of this. Can someone tell me? I'll give you a very sweet example. Let's say there are ESOP, employee stock options. Yeah, they are granted 100 employee stock options, and the pool created for the ESOP is for 1,000 shares. Pool created for ESOP is for 1,000 shares, and granted are only 100. In the fully diluted shareholding pattern, should we consider 1,000 or 100? Ask one question again. The ESOP pool is created for 1,000. Company has granted only 100 shares as of now. In the fully diluted shareholding pattern, should be considered 1,000 or 100? Aditya is saying 100. Nilesh Jain is saying 1,000. Lance is saying 1,000. Yogandar is saying 100. I need more answers. This is the last question of the panel of this discussion. 1,000. Naman is saying 1,000. Those who are answering will get a better certificate from Taxmann. 1,000. No, that's not a thing. 1,000. Okay. So great. A lot of people are actually saying 1,000. A lot of people are saying 100. Let me answer it for you. It is 1,000. You're absolutely correct. Those who have said 1,000, because the ESOP pool is already created for 1,000. So a person cannot consider 100 as the brand guested share. So hence it should be 1,000 as such, which should be considered. Now, give me another answer for it. A company is sitting on a land. The office is sitting on a land. Let's say where I'm sitting right now, this office is owned by me. Yeah. My company's valuation, business valuation is 100 CR. And my land valuation as of now is 10 CR. Should my valuation be 100 CR only, or should I add the land valuation to it and make it 110 CR? Lance is saying I'll not say what Lance is saying. Lance generally says right. So Aditya is saying add 10 CR. Should add. Silas saying should add. Land in case rent consider. Rajiv, you are wonderfully right. And even Lance is wonderfully right here. Uh, Land can only be considered when in the projections you have considered the rent. So a lot of people ask me, I am doing valuation, but why are you not considering my land? I own the land also. Why don't you add the value of land? I say to them, have you considered rent of the land while you're doing the things? If you have not considered it, you should ideally do this. Now, that is the thing. Then there are some debt-like items, some investments. In case company has investments into subsidiaries abroad, you need to value each of them separately, like that. So that's how. Otherwise, you would be giving land away to the investor without considering its value. Sile is saying land in case this. Sile is saying should add. No, sir, we are already reaping the benefit of the land already. So if you want to not give the land to the investor, hive it off beforehand. In case you want to give the land to the investor, just put the rent to it so that they will give you rent over a period of time if you own the land. So it's like that. So that's how the four pillars of then there are few startup valuation methods, scorecard valuation, all of those. That's about our firm. Thanks a lot, everyone. This is for the session today. Our firm is a 60-year-old firm, 1956. We are 30 partners. We have 700 plus employees. We operate across 7 locations in India. We have a global reach across 15 plus countries. These are my coordinates, my mobile number, my email ID. Anyone wants to reach out to me, you can reach out to me on LinkedIn. I'm quite active there. You can reach out to me on my WhatsApp number. You can reach out to me over my email. Generally, I take less calls, but on the WhatsApp and over email and over LinkedIn, I'm quite active. So that's great. I am looking forward to vote of thanks from a lot of people. Uh, thank you. Selva Tumuthu is saying very nice explanation, Gaurav ji. Thanks a lot. Thank you very much. I